All right, on to portfolio construction. And the first concept that we want to cover is portfolio grades. We develop portfolio grades to help people compile and narrow down their stock selections for their portfolio. And the portfolio grade represents the overall risk that each asset is contributing to the portfolio. So if you remember earlier when we were talking about covariances, I mentioned that this is going to come back up when we're talking about portfolios. So let's take another look at how covariance applies here. Walking you through an example, remember that the covariance is just the risk produced by combining assets. When we calculated covariance in the earlier section, it was a covariance between the asset and the index. And this uses the same math, except instead of using the index, you're using another asset. So what you do is you take all of those asset-to-asset covariances and you set them up in a matrix, whereas you essentially use it to analyze all of the assets in your portfolio against one another. Now in the initial example, that used a small data set versus this example on the right, which came out of our system and uses a 10-year history. So that's why some of the numbers here are a little bit different. But what you're doing here is if you go across the top row and add up all of the covariances, you arrive at an end result of 0.284%. And when you compare that to the other assets, you can then determine how much risk that asset is contributing to the overall risk of the portfolio. And seeing your portfolio from this perspective allows you to assess risk levels and make calls about what you want to include. Now, some assets will contribute a lot of risk, some will contribute only a little, and sometimes combining certain ones will actually help you reduce the overall risk of your portfolio. Covariances are a measure that the financial industry is well aware of. A lot of financial professionals have to know how to calculate them in order to get securities licenses, and it's also something that a lot of them are aware of as an option to leverage for portfolio construction. Now, whether they use it or not is not something that I could speak to, but what I can tell you is that they were trained over it, and what we did is we just took it a step further and added another grade here to help make understanding each asset's risk contribution a little bit easier. In an effort to help you understand exactly what we do for portfolio grades, we take all of those covariances and apply the grades based on the distribution of the covariances. In this example, the asset with the most risk had a covariance of 0.825%. As the riskiest asset, our system identifies it with a portfolio grade of R, and that way it's easy to identify the asset contributing the most risk to your portfolio. The other covariances ended up with grades that are much higher, A's and B's. So how did that happen? Well, you can see the distribution here and how most of the covariances fell on the left side of the curve. For the assets, the distribution from least riskiest asset, or the one with negative 0.025%, to the riskiest asset, or that one we just mentioned with 0.825%, becomes the distribution for the other assets, and this shows where they happen to fall. And then the grades are then distributed based on where they fall on that scale. Now, this can get a little more complicated. You might say with this example that you can just drop out that one asset from your portfolio and that will take all the risk away. Well, what happens when you do that? As the portfolio rebalances, it will identify a new asset as the riskiest asset, and you'll see a new set of grades based on the new distribution. And what's important to understand with portfolio grades is that just because you have an A+, or an A in this particular instance, having a whole bunch of them on the high end is not necessarily a good thing. This is just a way to represent risk. And it's true that if you have a whole bunch of assets that are B's or C's, that means that your portfolio's risk is more evenly distributed. You're still going to have an A and an R, but you want to have assets that are fairly evenly distributed. And if you have some that show up as a C or a D, just know that's not necessarily a bad thing. It just means that the asset is contributing more of the risk to your portfolio. And remember that risk in your portfolio is what's producing your return. So it's not necessarily a bad thing to have risk. It's just something that you need to be aware of so that you can manage it. Where it really comes into play for me and how I like to use portfolio grades is when you have a particular number of stocks in mind for your portfolio, and say you start with 5 to 10 more, and then use this method to see where the risk is coming from, and then you kind of whittle it down to your portfolio to that final number that you want to include. You can also use it for those instances when you have a stock in mind, but when you go to add it to your portfolio, you find out that it doesn't interact well with some of the other assets that you already have. So what this allows you to do is try out some other similar stocks, maybe stocks in the same industry, to see if there are other options that are actually a better fit for the assets that you already have. This can be a really powerful tool when you leverage it properly. It's just something where I really wanted to walk you through the math behind how it works so you have a clear understanding of what's going on here. That way, when you're testing things out on our website and everything is changing, you know why.